let us discuss all very important questions in commerce for intermediate first year students, and these are useful from the examination point of view. Let us discuss question as well as answer for that. Let me explain that clearly. So here first one is working capital. Working capital means it is a capital or amount which is used for day-to-day operations of the business. So for daily operations of the businessman needs some amount of cash. So that is compulsory for running the business. That is known as working capital. So that amount, how actually the businessman is going to utilize in the business. What are those daily operations? So for example, for purchasing of anything, for payment of salaries, and for payment of wages. So these all are regular expenditure. The amount which is incurred by the businessman for all these regular or day-to-day operations of the business, this is known as working capital. Hope this is clear. And if you want to know more questions and answers in 2 marks, you can go through the previous video, so that there actually I explained 20 questions, and here I am going to explain 20 more questions. So total 40. Very important, and more are there, more 10 questions are there. I will discuss those remaining 10 in another video. So here in this class I am explaining only 20. This is lecture 2 on 2 marks very important questions for first year students intermediate. From the examination point of view, these are very important. Let us go and discuss next one. So next one is long term finance. What is actually long term finance? How we can define this? By considering time period. So what is a time period for this long term finance? If any amount, finance means what? Funds required by the business. So if any funds are required by any business or an enterprise for a period exceeding or more than 5 years. So if business needs any funds for a period of more than 5 years, then we can call that finance as long term finance. So these are the funds which are useful by the enterprise for a period of more than 5 years. Okay, so we can call it as long term finance. So whenever we define long term finance, medium term finance, short term finance, we should consider time period. So what is the time period that the business is going to use those funds? Depending upon the time period, we are going to define those 3 finance: long term, short term and medium term. Long term, we can define it as if any funds are required by the business enterprise for a period exceeding 5 years, then we can call it as long term finance. When actually business requires this, if business wants to purchase this land and buildings, plant and machinery, furniture, so that time they actually use this long term finance. So these all are purchasing of machinery, furniture, these all are assets. So whenever businessman wants to invest money in any assets at the time of purchasing, then we can call it as long term finance. Hope this is clear for everyone. Let us move to next one. So next one is medium term finance. Just now, while explaining long term finance, I told you all that long term, medium term and short term, these 3 we can define by taking into account time period. So long term we defined by taking into 5 years time period. If it is for more than 5 years, it is a long term finance. So what is medium term finance then? Medium term finance means these are the funds that the business is going to use for a period of more than 1 year but less than 5 years. So then we can call it as medium term finance. Here the time period is in between 1 year to 5 years. More than 1 year but less than 5 years period. then we can call it as medium term finance. Hope this is clear for everyone. Let us move to next one. Next one is short term finance. So here how we can define this short term finance. Time period of 1 year. If any funds are required by the business for a period of less than 1 year. So here just a word is missing. I'll read this. Look, you can look into the answer. Funds which are required by an enterprise for a period. Period word is missing. After a you should take period. For a period of, that is missing. Period of is missing. For a period of less than 1 year. Then we can call it as let us discuss what is short term finance. Short term finance means here we should take a period of 1 year. If funds are required by the business for a period less than 1 year, then we can call it as short term finance. If you observe one point here, long term finance means more than 5 years. Medium term finance means it is in between 1 year to 5 years. Short term finance means less than 1 year period. Okay, so in case of all these three, we just consider the time period that the funds are required for the business. Okay, so short term finance means funds which are required by the business or by an enterprise for a period of less than 1 year. Then we can call it as short term finance. Hope this is clear. Let us move to next one. Next one is retained earnings. What are retained earnings actually? Retained earnings means every year business earns some profits. So whatever profits business is earning, it has to distribute in the form of dividend to shareholders. So if it distributes complete profit to the shareholders, then in future if business needs money, if company needs money, then it will be in trouble. That is why what the company is going to do is, out of profits, some amount of profit will be kept aside. So the profit whatever is kept aside without distributing to shareholders, that amount is known as retained earnings. So these retained earnings actually the business going to keep in the business itself for future purpose. In future if it needs money, it can use this retained earnings. Let me discuss what are retained earnings now. So actually every business earns profits. So that profit should be distributed to shareholders completely in the form of dividends. But if it distributes completely all the profits to shareholders, it may actually will be in trouble in future if any uncertain events occurs. If it needs money in the future, then amount may not be available in the business. So that is why what the company is going to do is, whatever profits it is earning, out of that some amount will be kept aside and they distribute only the remaining money to the shareholders in the form of dividends. The amount which is kept aside is called retained earnings. So these retained earnings will be used by the company or business in the future for any purpose. Okay, hope this is clear for everyone. So here if anyone wants to take long definition, you can use the first one, and if you want short definition, simple one, you can prefer second one. Let me read it once. Retained earnings. A company generally does not distribute all its earnings among the shareholders as dividends. A portion of the net earning means net profit, may be retained in the business for future. This is known as retained earnings. And let us discuss, let me read short one, simple one. A portion of profit which is not distributed among shareholders is known as retained earnings. Hope this is clear for everyone. Let me discuss next one. So registered debentures is the next one. Registered debentures. This is one type of debentures. There are different debentures we have. So here registered debentures are one kind of debentures. In case of registered debentures, a business maintains one register, and in that register company records all the names of the debenture holders. So whoever actually is the owner of the debenture, that name will be recorded in the register of the company. So register is maintained in case of registered debentures. If suppose the debenture holder sold his debenture to another person, the other person whoever purchased have to come to company, and he has to replace his name in the place of that old debenture holder. So new debenture holder name will be again recorded in the debenture register. Okay, so this is registered debentures. So old debenture holder name will be cancelled and new person name will be recorded there. So because here they have to know, company has to know compulsorily who are actually the debenture holders, and that register will be maintained. This is about registered debentures. Actually debentures are debt capital for the company. Okay, so debenture holders in return they get interest from the company every year. Let me read the definition. First one is the definition which is a little bit long, and down one that is very simple one. You can prefer anything in the examination. So let me read it. In case of registered debentures, the name of the holders are recorded in the books of company. If such debentures are transferred, the name of the new debenture holder is entered in the register of the debentures, and previous holder name will be cancelled. So I told same thing now. So let me read the next one, that simple one. A register of debentures is maintained by a company. The names of debenture holders are recorded in the books of the company. That's it. It is very simple. If you want to write more story, you can add those points, whatever I actually have written for the first definition. Let us move to next one. So next one, bearer debentures. This is another type of debenture. So that previous one is registered debentures. So that is one type. Bearer debentures are another type of debentures. Debentures always is debt capital. So debenture holders every year they get in return interest from the company. So who are bearer debentures? Bearer debentures are actually those debentures whose names are not recorded in the register. There is no register for these debentures. Then how actually we can determine who is the owner of the debenture holder? Whoever holds the debenture certificate, he will be called debenture holder. So the one actually who is holding those debenture certificates, he will be known as debenture holder. So we can call that particular debenture as a bearer debenture. So these debentures are transferred easily from one person to another person, and they need not to go and record their name in the register of the company, because there is no register that will be maintained in case of these bearer debentures. So these debentures are transferable by mere delivery. If anyone holds the debenture certificate, he will be treated as debenture holder. So we can call him as a bearer debenture. So let me read this. The first one is a definition which is a little long, and the down one two definitions are there. So out of those two you can prefer any one for short. Second one is short one and third one also is short one. So some points are mentioned there. Let me read what are those actually. The debentures which are not recorded in the register of debentures holder are known as bearer debentures. These debentures are transferable by mere delivery. And short one, two are there. You can prefer anything for short. So, let me read what are bearer debentures. Bearer debentures, first one, the debentures which are not recorded in the register of debenture holders are known as bearer debentures. These debentures are transferable by mere delivery. So, next, down two are there. Those two are short one. You can prefer any one for short definition. Let me read that middle one. Which are not recorded in the register of debenture holders is known as bearer debentures. And the last one, the debentures which are transferred by mere delivery are known as bearer debentures. So, next two, first one is you can take for long definition, and next two, second one, third one, middle one and last one. These two actually are short, simple definitions. You can prefer any one out of these two, either second one or third one. Okay. So, this is about bearer debentures. Let us discuss next one. Shares. What is share actually? Share means part of the capital is called share. Capital of the company is divided into small equal parts. Each part is called share. Suppose capital of the company is, for example, 1 lakh. If it is divided into 1000 parts, we can call each part as share. 1000 shares are there, and each share value may be 100. So 1000 shares into 100 rupees, capital is 1 lakh. Okay, share means it is part of the ownership capital. So capital of the company is divided into small equal parts. It is called capital. If anyone purchase, if it is called a share. So if anyone purchase share, we can call him as a shareholder. Shareholder is real owner of the company. Okay, because they are contributing towards the capital of the company. So shareholder, every year in return he gets from the company dividend out of the profits. This is about shares. So let me read what actually is the answer here. First one and down one, second one is a simple definition. If anyone prefers simple one, you can take down one. So if anyone wants to write more information for 2 marks, you can prefer first one. First one, a share is part of ownership capital. Shareholders are paid dividend on the shares held by them. Shareholders are the owners of the company. Let me read simple definition. A share is part of ownership capital. Shares get dividend. So this is about shares. Let me discuss next one. Public deposits. Public deposits actually are collected by organizations. They raise it whenever they want money, and they can collect that directly from the public. So they can sell the deposit certificates and they can collect money from public directly. So here public, if anyone is interested to deposit their money in particular organization, he will purchase that public deposit certificate and he will deposit money in the organization. And how actually it will happen? So he will come forward and fill the application form and he will deposit money. Okay, this is about public deposits. So organizations who wants to collect or raise amount from the public, and then they can go for public deposits, and public, those who are interested, will come forward and deposit their money with the organizations. Okay, so let me read that. The deposits that are raised by organizations directly from the public are known as public deposits. Any person who is interested in depositing cash in an organization They can do so by filling up a prescribed form. So simple definition is given down. Public deposits are raised by organization directly from public. That's all. It's very simple. You can take any one. So let us go and discuss next one. That is cash credit. Cash credit is one type of loan given by bank. So banker, what is the main duty, main function of the bank? It accepts deposits, lends loans. So deposit can be accepted by public, and loans also will be given to public. It may be directly to public or to businessmen, to anyone. So what kind of loans that bank can lend to others? There are different types of loans. One is cash credit. So cash credit is one facility that will be given by banker, that whenever this cash credit loan is given, total amount of loan will be credited in the account of that person to whom the actually loan is given. So if the loan is given to one businessman, so total amount of money, whatever is the loan amount, that will be credited in the account of business. Business or person, whoever takes the loan, he can withdraw money from the account at any point of time whenever he requires. But interest is charged only on withdrawn amount, but not on total amount. That is the nature of cash credit. So in case of cash credit, actually loan amount is credited, but interest is charged only on withdrawn amount, but not on total amount of the loan. Okay, this is about cash credit. So let me read this. Let me discuss what is cash credit actually. Cash credit is a loan facility that is given by banker to his customer. So what is a feature of this cash credit? If banker is giving this loan facility to the customer, the amount of loan will be credited to the account of the customer. So here customer can withdraw amount at any point of time, but interest is charged only on withdrawn money, but not on total loan amount. If anyone gives loan, they will charge interest on complete loan amount. But under cash credit, interest is charged only on withdrawn amount, but not on the total amount. This is the main feature of the cash credit. Let me read what is cash credit actually. So here bank grants the cash credit up to a specified limit. Business firms can withdraw any amount within that limit. Interest is charged only on the actual amount withdrawn. Okay. So down I mentioned this simple definition. You can see that also. It is a loan given by bank to business. Interest is charged only on withdrawn amount. This is the simple definition. Let us go and discuss next one. Overdraft. Overdraft is another type of loan facility that is given by banker to the customer. But this overdraft facility is given to businessman. So customer must be a businessman. Then he will get the overdraft facility. So that businessman has to open current account, then he will get this overdraft facility. Because what is the main duty of the banker? Banker function is accepting deposits and lending loans. So overdraft is one kind of loan which is given to business people. So businessman has to open current account, then he will get the overdraft facility. So overdraft facility means what actually the this businessman is going to get. He can withdraw more amount than his deposits. Suppose he is having 1 lakh amount of 1 lakh amount of deposit in the bank. He can use 1,50,000. So extra 50,000 he can use. Okay, this extra amount that what he is using is known as overdraft. This will be given only to the current account holders, not to everyone. So next one is, before going into next one, let me read what is this actually. So overdraft facility is given to current account holders. Under the facility allows the business firm to withdraw the amount more than the customer's balance in the bank. So under this facility, so what actually bank is going to allow? Bank is going to allow the business firm to withdraw the amount more than the customer's balance in the bank. Okay, and what is a simple definition? There is a simple definition here: withdrawing more amount from bank than our deposits, that is called overdraft. So let me discuss next one. So next one is trade credit. So trade credit means it is a credit facility given by one trader to another trader. So here one trader gives the facility to another trader whenever the another trader is purchasing goods from the first one. So credit period will be allowed. So the one who is purchasing need not to make payment immediately. So he can make payment later. He can purchase goods now. So this is known as trade credit. Trade means purchasing and selling of goods. So in that activity, means in purchasing and selling activity, if any credit facility is given, that is known as trade credit. So here trade credit actually is a credit that will be extended by one trader to another trader while purchasing of goods and services. Okay, so here he need not to make immediate payment. So due date will be there. On due date he has to, the one who is purchasing goods has to make the payment. So let me read this. Trade credit is a credit extended by one trader to another for the purchase of goods and services. Trade credit gives the facility to purchase without immediate payment. So let me read simple one also. Trade credit is a credit extended by one trader to another for the purchase of goods and services. These are the definitions of trade credit. Let me read next one. Next one is lease financing. So what is lease financing? So lease financing actually is an agreement, contractual agreement, where actually two parties are there. One is owner of the asset, the other one is the one who is going to use the asset. So there will be an agreement in between those two parties, and this owner is allowing the other one to use his asset. Why? Because the other one who is going to use will make some payment, periodic payment to the owner. So that is known as lease financing. Okay, let me read this. A lease is a contractual agreement whereby one party, that is the owner of an asset, grants the other party the right to use the asset in return for a periodic payment. This is lease financing. Let me read simple one. So down I have mentioned simple definition. A lease is a contractual agreement between owner and the other person to use the asset. Let me read next one. Next definition is commercial paper. Let me explain what actually is commercial paper. Commercial paper actually is one type of term finance in our country which actually emerged in the early 90s. So these commercial papers are unsecured promissory notes. So here these who actually will issue this commercial paper? Business firms. Firms are going to issue this. So whenever they are going to issue, they are going to collect funds from the public who actually are going to purchase the commercial paper. And what is the time period of commercial paper? It is actually for short period. It will be issued for a short period, and time period is in between 90 days to 364 days. This is a time period of commercial paper. Let me read. First one is a little long, and down one a simple one. You can prefer any one in the examination. Commercial paper emerged as a source of term finance in our country in the early 90s. Commercial paper, an unsecured promissory note issued by a firm to raise funds for a short period from 90 days to 364 days. So here after commercial paper, it is not and, it is an unsecured promissory note. Okay, you can just change it. It is after in second line, commercial paper, an unsecured promissory note. Okay, let me read simple one. An unsecured promissory note issued by a firm to raise funds for a short period from 90 days to 364 days. It is called commercial paper. Let us go to next one. Co-partners. Co-partners. Who are co-partners? In India, actually, joint Hindu family businesses are there. So, joint Hindu family means where actually grandparents, parents and their children are living together. And if that joint Hindu family is doing any business, we can call it as joint Hindu family business. They follow Hindu law. So, here in the family there will be so many persons. Head of the family is called Karta. I discussed in the previous session also about Karta. Head of the joint Hindu family is called Karta. And remaining all persons in the family are known as co-partners. So remaining all persons in the joint Hindu family is called co-partners. Co-partners have to listen the words of Karta always. Karta is having right to prepare accounting records and no one should question Karta. Karta is not answerable to anyone. And here who can become Karta? The eldest member in the family can become Karta always. So remaining all people are known as co-partners and everyone will become co-partner or member of the family by birth in the joint Hindu family. Let me read this. The head of the joint Hindu family business is called Karta. The other members in the joint Hindu family business are called co-partners. So let me read simple definition also. The other members in the joint Hindu family business are called co-partners. Simple one. You can prefer anyone in the exams. Let me discuss the next one, that is MSMEs. MSMEs. M means first M is micro, second S is small, next M stands for medium, E stands for enterprise, S enterprises. So MSMEs means micro, small, medium enterprises. Okay, so here actually this micro, medium, small enterprises they can do their business with the provisions which are mentioned in MSMEs Act 2006. So under this act, MSMEs are mainly of two types: manufacturing enterprises and service enterprises. Okay, this is about MSMEs. So let me read this. MSMEs means micro, small and medium enterprises. In accordance with the provisions of Micro, Small and Medium Enterprises Development Act 2006, MSMEs are divided as follows. First one, manufacturing enterprise. Second one, service enterprise. So down one is a simple one. You can prefer anyone in the examination. So let me explain next one. Just now we discussed micro enterprises, small, medium. So here what are micro enterprises? Micro enterprises means it is one enterprise where actually the investment in the plant and machinery is not exceeding 1 crore. If investment in plant and machinery of that particular enterprise is less than 1 crore, then we can call it as micro enterprise. So if that enterprise is going to invest its money in plant and machinery which is less than 1 crore, then we can call it as micro enterprise. Okay, let us go to next one. Let me discuss what is small enterprise. Small enterprise, micro enterprise, medium enterprises. These all can be defined depending upon its investment in the plant and machinery. So micro enterprise actually is an enterprise where the investment in the plant and machinery of that particular enterprise is less than 1 crore. Small enterprise means it is an enterprise if its investment in the plant and machinery is more than 1 crore but less than 10 crores. If investment in the plant and machinery is in between 1 crore to 10 crores, we can call it as a small enterprise. Let me discuss next one. Next one is medium enterprise. Now let us discuss what is medium enterprises. So this medium enterprise also can be defined by considering investment in plant and machinery. So if investment in the plant and machinery of that particular enterprise is more than 10 crores but less than 50 crores. So investment in plant and machinery is in between 10 crores to 50 crores. Then we can call it as medium enterprises. Let us go and discuss next one. MNCs. MNC. MNC means multinational corporations. First M stands for multi, N stands for national, CS means corporations. So MNC is what actually? it is actually made out of two words, that is multi and national. So multi is one word, national is the other word. So MNC, multinational, MNC word is made with the help of two words. Multinational word is made with the help of two words, multi and national. So here multinational corporation means actually, so one organization, if it is doing business in more than one country, then we can call it as MNC. Okay, there will be host country as well as the other country. So here one country, its business, it is doing in more than one country. So we can call it as MNC, multinational corporations. Okay,